I don't usually do unscheduled lives, but I figured given what's happened this morning, OPEX, etc., we would talk about some flow. So if you want to just chat, that's cool. Put in something in the chat there. We'll go through it. But what I wanted to cover, and I'm speaking in the abyss by myself here, as I think I believe we are streaming live here. All right, we are. Let's go. This is the abyss, as I like to call it. And the problem with the abyss is that, as you can see on your screen, we have nothing but red everywhere. There's these two strikes, 6,500, 6,475, that are some 0DT strikes and offer some, I will call it local positive gamma. But all in all, this is the kind of market where you would obviously anticipate large moves. And a lot of you are probably saying, well, that is not terribly shocking, as if you go and you look at short-dated realized volatility, you see that the short-dated realized volatility, so if you look at 5-day vol or 1 month vol, we're 13. This chart obviously will be much higher after tomorrow, after we include tomorrow's update. So there is no doubt a lot of volatility. Now, what is the problem with this? Well, here's the problem. We have OPEX today. Now, as we talked about in the morning note, OPEX is now heavily put skewed. So these numbers were more 50-50 in index land, 50-50 in the ETFs. S&P was 60% calls like 2 days ago. So this is all much more negative. It's not a huge options expiration. We mark it as about, you can see the delta values in here, but if you're going to use the Goldman notional value, it's about 3.6 trillion is what we have it as. Trillions are an absurd number, but that's how we measure it every week. If you look at something like a big quarterly expiration, you can talk about $6 trillion. So, what's a trillion these days anyways? So you have all of these puts expiring. You have all these values expiring. You also have vols that are pretty expensive. And so you sort of stare into this, and what you see here is plenty of room in either direction, obviously. And what we're trying to figure out, you can see there's a line on this map, right? And what this line on the map is telling us is this was 9:30 a.m. expiration. That's when the bulk of S&P 500 contracts expire. So you have a big SPX index adjustment here this morning that causes the map to be a bit different. And it's a very smooth red zone everywhere else, which just infers plenty of room to go up here and plenty of room to go down here. Now, the problem is the volatility here. As we mentioned before, we're going to look at fixed strike vols right now to get a sense of what's happening. And you're talking about 20% at the money implied vol for the S&P. That's pretty high. So if we scroll to the right here, you can see this is fixed strike vol. So there's your strikes, there's your expiration, plus 20%. That's elevated. There's no two ways about that. If we look at what vol has done over, let's just say, since last night, we're down a little bit, as you can see. So this is current vols, fixed strike vols versus yesterday. We're actually down a little bit. If you look versus Wednesday night, you can see the vols are absolutely up for these longer dated expirations. So the problem here is that these vols can be very rich, right? But they're not so rich that you would say it's impossible for them to go higher. So what do I mean by that? Well, if the VIX was at, say, 50, then buying a put when the VIX is already at 50, as an example, the payoff of that structure starts looking so good. So, stops looking so good. VIX 15 buying puts makes more sense, arguably. But so vol's not too rich, not too cheap. And the problem here again is you have expiration, right? Today, then you hit the weekend, and then we hit Thanksgiving next week. So you have all of this energy built up into puts. The downside, vol is obviously quite elevated. If you go through any of these different indexified volatility measures, what you see is obviously very elevated implied vols. And these vols are just as elevated as they've been, since April, maybe. This is the October spasm. If we look at VVIX, same thing. Goldman had this volatility indicator that was as high as it's ever been. But, look, this is not April, but you're talking about outside of April, where we all stared into the kind of abyss of the financial system, right? This is about as elevated as it gets. So on one hand, you sit here and go, great. Expiration should relieve some pressure. Weekend should relieve some pressure. Next week should relieve some pressure because it's a shortened period. And if you own puts, when vol is high, that decay is extra high, right? So it is not at all free to carry put protection. And you can make a case that, look, a lot of these indexified volatility measurements are kind of topping out. But at the same time, are we looking at an April, type scenario where you get this spasm where VIX could easily go 40, 50? And the reason I'm bringing this up is because if you just consider where we were last August, right? We went into the weekend where things weren't that great. They were pretty chippy. And we had this big yen carry trade problem allegedly on Sunday night. And that suddenly had the VIX print at over 65. No, VIX officially doesn't print, but it was marked that. And the vol traders out there will tell you that that wasn't real. But the fact of the matter is that was a function of liquidity, right? Liquidity just went to zero. And suddenly when the market opens on Monday morning, it was like, spreads are $50 wide on so you had no liquidity in the VIX prints as a function of that lack of liquidity and kind of chaos. And that sort of, you get that vibe right now, right? When you go through the list of what is wrong, you have the crypto market, the JGBs, you have one Fed governor saying volatility is good. They're trying to walk that back maybe this morning. You have the AI story is kind of I mean, you can go through the list of problems here, and there's like 9 of them, but there's not one clear catalyst. So what the problem is then is that usually what happens in these markets is something breaks, and that sort of brings the resolution to the problem, right? Because the powers that be will come out and say, well, here's some liquidity, here's a fix, like, don't worry about it. And I guess the Bank of Japan, I know nothing about this, seems to be suggesting something like that, but nothing has yet fully broken. But these moves are the kind of things that break something. So if you think about the difference being like, hey, what happens when the banks go down, right? Silicon Valley Bank. Into that weekend, we all start to panic because we know that there's a banking problem and these other banks could start to go down, right? So that weekend is very ugly. Then the Fed comes in ultimately and says, we're going to bail out the banks, and go, great, problem solved. Now, in this case, it's like, well, what is going to break that brings out the resolution to that problem? Because we're caught in this kind of reflexive loop. You look at this Bitcoin as a proxy for risk, that's about as bad as it gets. What stops this? I don't know. Is this the situation where MicroStrategy breaks? I don't know that either. That seems a little bit hyperbolic, but again, that could be something that breaks. You're talking about the yen. Is that something that breaks? You just don't know into this weekend, which makes selling vol here, while that seems like the obvious trade, or a more obvious trade, selling vol here seems to make sense. At least that's what seems to be getting a bit juicy. But VIX at 26 is not that screaming sell, right? If you're going to get VIX 50 or something, vols are that elevated, and you're like, okay, the risk premium now available makes it more worth it for me to stick my neck out here. If we look at the map, there's no real support in the market at this moment until 6,500, right? So that's quite a ways down. As we clear out these levels. So at the moment, easily move 1% up or down based on what we're seeing. Now, the big signal yesterday that was such a powerful signal, I will say, and I wanted to talk about the way that we framed yesterday's market movement. I, like a lot of people yesterday, went into the market feeling that this should be a bullish lean out of the NVIDIA events, out of the jobs events. But we marked this level 6,700 as, look, if this level is broken, then you want to be meaningfully risk off, right? That is the adjective that is critical here. And so that happens, and we spill into sort of this abyss. So everything is a set of if-then statements ultimately, right? Because no one really knows which way the market's going to go. But if you're going to tell me we hold this level, vol can come in, you can start to outline this is where positions get more supportive of the market, right? This is where resistance comes in. These are the two options. So right now, as long as we remain in this negative gamma position, which is in the 6,700 area, you can't possibly point to one direction and say this is the direction we're going, because number one, we don't really know what the clear catalyst is. And so if you don't know what the catalyst is, you can't flag the resolution of those catalysts. Now, if Bitcoin stops dropping, if we see put selling come in, if we see some price stability and positional stability, then maybe that's something you can ratchet onto. But again, the issue is right now is you don't know what the trigger or the cause of the volatility is. If you look at, this was the Goldman chart earlier, they were looking at the Oracle credit default swaps. I think it was in this chart, it was in a different one here. But those are obviously going off. And as we've said many times, when the credit market starts to break, that presents or brings in a price insensitive buyer of equity puts. Why? Because if you own Oracle bonds and you're freaking out right now, the way that you would hedge yourself is by buying equity puts, because equity will go to zero before bonds. And so when we're looking at the positions down here, quite frankly, even though this was so ugly yesterday, there's not a lot of long puts. It doesn't seem like a lot of people hedged out this flow yesterday, right? You would see negative bars like this one at lower strikes if indeed this positioning was negative, if people bought puts. So this is our synthetic open interest, and this is how we track our positioning every day. What does it seem like people did yesterday? It actually seems like they sold puts. So the market makers now are long puts is what we model out here. That's not something that you would see in the case of, again, if we're really staring down the barrel of financial Armageddon. So again, this is the Goldilocks situation of like, vol's not too rich, vol's not too cheap. So it's not an obvious sell right now, even though it's very expensive to own puts and carry them over something like a weekend. So this is the chippy sort of situation. Now, you're always going to sit here and say, well, what is the way that you want to play this? And so the way that we said, hey, let's look at the only trade that I think is not the only one, but the one that just seems to make some sense here is we recommended this morning call flies. And so the interesting part about this call fly, and you could do this in the Qs, I think, or spiders if you want, is this is a 1x2 long. The 665 calls for 12.5 and short something like the 675s. Obviously, the market's moving around, so you could do that for roughly dollar neutral. But what's interesting to me about this is you say, well, if I sell puts into a weekend where I don't know what could break, right? There's a myriad of things that could break, and then we could have like the August situation, right? Because that's what's cooking. You need a trigger for that, and to be fully clear about that, you need that trigger. But let's say the market does start to rally because it's the weekend and nothing bad happens. If nothing bad happens and time decays, right, we move forward in time, and then guess what? The market's going to rally based on the vols getting crushed. This is kind of the Vanna concept here. So you see the market implied vol, right, what we're currently pricing in is this dashed line. And so what the 1x2 does as we adjust skew and things is the purple line. So what do I mean by that? We can run a similar scenario here just to talk about this structure. Now, I want to go with the short-dated positions here. And the reason I want to go with the short-dated positions here is because I think what I'm trying to do is I want to play that decay, and I want to play where I think the S&P will rally to. So essentially what I'm trying to do is get myself a free call option into this decay. And so where do I think the S&P could rally into? Something like the 665, 660 area seems to make sense to me. And then that resistance, based on what we're looking at in the positions, would be around the same area, roughly 675. And again, I'm doing this fast live, so you want to play with these structures a little bit yourself. But this is the 1x2. And the reason I want to go with the shorter dated expiration, something like 12.5 or even shorter, is because what I want is these two 675 calls to get pummeled if vol contracts, and that offsets the cost of me getting long delta. So this is a little bit of a more of expensive structure than I'd want to do. Maybe slide this up a little bit. Again, play around with the strikes. But the point is the path dependency, both of time and how volatility would change in a rally is what's critical here, right? So this is a little bit more of a dollar neutral trade at $162 to do this. So if you hold it to expiration, this is the P&L. We've all seen this before, but I don't necessarily would want to hold it to expiration. What I would want to do more likely is trade this thing into the Thanksgiving holiday after I've collected a lot of that time decay, for example. So in this current structure, as we shorten the dates, what you see here is a very small P&L window based on current vols. But what happens if volatility starts to adjust, right? What happens if the skews start to adjust? So vol comes in even fairly substantially. This cone is the range of vols over the last 90 days. The teal line is the current skew. And I can flatten the skew out, or I can elevate the skew depending on what I want to do. Also for put selling, you can flatten or raise the skew as well to get the shape. So there are other systems out there that will allow you to move the vol up and down, but they don't really allow you to adjust that skew. So that's a pretty good vol slam here. But if I just move it a little bit, now you see the difference in the P&Ls, right? Remember before, and I initially had this trade up, you go, that's not all that attractive of a trade if we rally up in this area. But now look what happens when you adjust that vol, right? Because those 675 contracts should get nuked, right, over a weekend where there is no event, right? Because why? If nothing happens with the VIX at 25 as an example, you need 1.5 to 2% daily moves in the S&P to justify VIX at 25. If you don't get that kind of movement and you go into a weekend, and then guess what happens? That time decay is an absolute beast, right? Particularly when that vol is that high. So when you adjust the volatility, then this structure gets a lot more interesting. Right? You can see the P&L starts to get a lot more robust. And again, you can slide these strikes around just to get that idea. But to me, when I look at this, I go, this is the interesting trade to me because it's pretty fixed risk on an upside rally, which is totally viable. And the easiest thing to model out is if market rallies, that vol comes down into these weekends. So that and the holidays. So that is the kind of idea here that we're trying to sort of express. A couple of people showing up in chat. Good morning, everybody. I think that if you're looking at the possible upside, I still think the 7,000 strike is what you want to look at, and who knows what they could throw at people. But the reason that I'm watching that 7,000 strike is this is just raw open interest, right? So if you just look at all the positions on the board, there's massive size here at 6,000. I don't think that's necessarily pay, but you got big open interest all the way up into 7,000. So over that, there's nothing. So I think that 7,000 level is, if you're talking about 1231 best case scenario, that still is the best case scenario. The other thing that's funny about this is that if you just look at how much volatility there's been in the market recently, just over the last month, right? And you talk about, well, that seems so far away and that seems impossible now. But this was the Trump, tariff spasm when vols, I think, were the driver of this just disgusting downside. You had a 3% drawdown there, right? And then what happened from there? We went from 3% drawdown to 5% rally up into that 9,200 area in the course of just, 2 weeks. Funny enough, right at options expiration, that seemed to release all of this pressure. And then you have this big rally. Then what happens right after OPEX? We drop 5%. So, we're basically where we were during that Trump tariff tantrum. And you got 6 weeks plus all these holidays, plus FOMC, plus Oracle earnings, plus people thinking the end of the world. So it's like all of these catalysts can unwind and you could get the Santa Claus rally. You can't say that doesn't exist. Now you can easily make the case for a lot of downside too. And so what is the major downside level? We've been flagging 63.50 as the big level. Now that level happens to line up. So if we just look at the GEX chart here, why do I like 63.50 as a washout level? We obviously know that's where the JP Morgan strike is for the end of the month. So it's right here. That's that big strike. I can make this a little bit bigger, but look at the gamma underneath that, right? It starts to get less negative under that level because there's not really that many put positions down here. There's not, if there were tons of big negative strikes, what you would see is the gamma would just be drifting to the bottom left of your screen, and it's not. So if you talk about gamma as a driver of downside flows, well, that really subsides under that level. So there's plenty of downside fuel, and then it subsides. Now, obviously, if there's a credit market issue that drives this, or some sort of unknown, known unknown credit market issues, bank collapses, blah, blah, blah. Then there's people who are like, I'm going to buy vol for 1 month, 2 months, 3 months out because I don't know what's coming. Like when the banks are failing. Okay, banks are failing. I don't know when and if this will be resolved. I can't hedge that with the 0DT option. And at that point, if you look at yesterday when people were trying to figure out what's going on, I am not going to say that the trigger, at all. I'm not going to tell you the trigger of the flow was the options market. Something happened at 10:30 yesterday, and we went from about positive 1 billion in the HIRO chart, which is what you're seeing here, to about negative 13 billion. And this was predominantly 0DTE. And then when it got ugly enough, longer dated put buyers stepped up a bit. And then we saw a lot of single stock call selling. So, and put buying. So there was this cascade of flows that I think was initiated by, you want to call it CTAs or just a bad headline, whatever it is fine. But the baton was passed from the 0DT complex to something else. And I talked about this actually on Twitter, because if you look at the Twitter feed yesterday, I broke down the flow. And if you're a SpotGamma subscriber, you know I talk about this all the time. Look at this, man. Skrelly's beating me. That guy. If you look at the flows, right, from yesterday, we broke this down. So yesterday we traded 6.4 million spider contracts. SPX contracts. You can see the put call ratio there was 3.5 million puts in total versus 2.5 million calls. Now, 3.7 of that 6.4 was 0 DTE. That's about 58%. 4.4 was today or earlier, because today was obviously options expiration. And then when you use our synthetic open interest and you break down what is the maximum number of contracts that were traded, both bought and sold, that could possibly have been tied to like a hedge fund or retail trading, it was only about 350,000. So you're talking about 5% of the total S&P flow was like somebody being like, I need to buy a put for January because this is scary and I need to hedge this position. That's not a lot. Like, that's not a capitulatory freak out kind of situation. And on that point, if you look at our Flow Patrol report, and by the way, if you want to try Flow Patrol, go to spotgamma.com/Flow Patrol. Go right here, and you can get the report free for 7 days. What we do here is we look at the biggest changes day over day in our synthetic open interest. I call it SGOI. It's our models. We pull in where we think hedge funds and retail are shifting their positions. What options are they buying and selling? So those of you who saw my Twitter feed this morning noted this big put fly, for example. I was looking at the P&L of that trade. Is pretty interesting. So somebody bought 150,000 of the 515 puts, sold 300K of the 555s. So this is a very good, interesting downside hedge. We'll talk about that in a minute. But what I wanted to flag here were kind of two things. Number one, if you look at largest index trades, so this is the biggest changes in our synthetic open interest for what we model as hedge funds and or retail. There's nothing in here in the S&P size really of 10,000 or bigger. You think about the JP Morgan collar trades of 40,000 lot and how much ink is spilled, so to speak, on that position because it's 40,000. Think about Captain Condor, who can oftentimes be 20,000. Like, where are these big put buyers if you think the world's going to end? Now, you could just sell stocks, so you know what to hedge, obviously. But, you know, if you look at this stuff, all right, there's 12,000 here. This is sold to open, though, right? So it looks like somebody put on a 0 DTE or 1 DTE spread there. This we see in the synthetic open interest, 64.75. So if we go to Trace, I just want to make sure we tie all this together. Now, Trace updates every 10 minutes. So there's your 64.75. Clearly, somebody is now closing up this thing, right, to 6,500. Let's take a look at that. Yeah, see that 6,500 put? That was a short put position. Dealers own the put. It was quite a bit higher, and it was 6,000, and now it's only 2,000. So that put's getting closed up. That very well could have been the source of some market bounce. Let's just wind that back real quick. So there's the put, 9:10. It's live, full size, market's up. This updates, the map updates every 10 minutes. HIRO is real time, still there at 9:20, 9:30 still there, 9:40 it starts to get closed. There's this positive delta pop, likely sourced with this position getting closed up right here. So now if you're like, what is the material support in the market? We've got to mark that down a bit to 64.75. You can cross-reference that, obviously, with the Flow Patrol showing this looks like a possible put spread, 64.75, 63.75. But anyways, the point is, where's the size here in the SPX? You know, I'm talking about like, hey, Bridgewater buys 100,000, you know, some big fund, 100,000 puts because they're worried that the world's going to end. They did that in March 2020. We just don't see the size there. So this backs the idea that there wasn't significant flow. And one of the things we do here is we break down, and we call this the high frequency trading signal. So you'll see with a lot of the flow bros out there, they'll go, look at this trade, look at this trade. And it's actually meaningless because it's a market maker to a market maker or someone opening and closing on the same day or whatever it is. So here you see the total volume of these options. And then you see, we call it the synthetic open interest change. So like, how big was it? Spider, for example, traded 15, almost 16 million contracts yesterday. Only about 1.5 million of those was tied to an actual fund retail position that held their position, didn't buy it and sell it intraday, right? They bought it. I'm buying January puts because the world's ending. So you can see the ratio here of these flows, right? So NEE, don't know anything about that. Obviously, you know, big negative flows, but NDX, similar thing, right? We had the NDX yesterday was the QYLD trade. That's a lot of this flow, like the 12,000. I'm sure a bunch of that was related to the open interest change there. So what this speaks to is a lot of day trading, right? And this is the SPX. The official mark of the open interest change was 600K. So that includes calls. So 350 puts was what I mentioned before. Calls is the other side of that. So you can see only about 10% of the total volume related to actual position changes. And why does that matter? It's because if you're going to talk about gamma exposure or delta exposure or vega exposure for market makers, well, it didn't increase all that much relative to the total volume, right? And a lot of this flow is the market makers themselves. So you try to parse through that, how much of that flow is meaningful. What would scare me? If someone's buying 2 million puts, right, and that's all hedge funds and retail, and everyone's buying puts because they are just totally freaked out about what is about to happen. That would add a lot more convexity to the downside. That convexity at this moment doesn't really seem to exist out there. So that's a critical thing. Last thing on the flow patrol report, you see a bunch of interesting risk reversals, I would say, in Nvidia and things like that. But I wanted to flag this lift trade because if you want to get bullish about something, someone out there bought 30 grand of these March longer dated 25-30 lift call spreads. Now I don't know if this is part of another trade or something else, right? But I can say with a high degree of confidence, they bought 30,000 of 25 calls. They sold 30,000 of the 30 calls, so $5 wide call spread for March. That's a material position, about $2 million of net premium spent on that, roughly. All right, that's real money into the abyss, right? The other one that kind of caught my eye was these February 140 shop calls, about $17 million spent on that, right? Now that's a kind of at the money option. And again, you don't know, are they hedging some other type of position that they already have on, et cetera? But I like those bigger, chunkier, slightly longer dated options positions as a possible directional signal. Like you look at that lift trade in particular and you say, well, on a day like yesterday, you're going to stick your neck out there and buy $2 million worth of lift call spreads. All right. Interesting name to check out. And there's been a lot of big winners that we found in that arena before. But one of the things that you don't usually see when you're looking at some of the biggest trades on the day is the largest premium trades. A lot of these risk reversals. Lennar, big risk reversal there, selling call to buy a put. So selling 20K calls. Looks like they closed the position, maybe rolled some. So selling 13,000 there, buying 13,000 there. Risk reversal in Nvidia as well, 40,000 lot. Selling calls, buying puts. So those are pretty big trades. Here's one interesting put spread, opening put spread in the Qs for 12.12 as well. So Microsoft had a big risk reversal. So did Nvidia. Looks like a rolling risk reversal in Lennar as well. So those are some of the more of the larger, I would say, negative trades. But you didn't get the feeling at all that this was it's kind of like giant long Vega trade that necessarily was showing up based on the data, right? Yes. So like there are these times where you stare into the edge of the abyss. And I remember this most vividly in August of 2015 when the market had this giant crash and there were these size put positions going on, massive put positions going on that just screamed the idea that somebody was hedging a major problem, right? And again, the problem with that is if the market starts to feed down, then there's Vega, there's convexity, right? And that convexity is where you get kind of these end of day moves. But it changed a little bit. Could Jane Street be exploiting market structure? Well, I mean, when you look at this is like the funny thing about yesterday. Like in HIRO, we don't know who's doing the buying and selling, right? And we talk about yesterday's flows, for example. You don't know who was doing the buying and selling yesterday, right? But you know what the size is. And so when you look at this, and this is what I was talking about yesterday with the flow, is here's 1045 really, and then all of a sudden this just spills. And you see the T line is 0DT only, and up until about $4 billion, right, the spread between these two is not all that wide. So all expiration flow versus just 0DTE. And it's meaningful, right? It's about, if we break this down by puts and calls, this is the 0DT put line, the light blue. And then we get down to 6,600-ish, right? And that flow seems to subside a lot. But the spread between these two, and if you're a SpotGamma subscriber, you know I always talk about the longer dated flows being more important in terms of directional signal over the longer term. So it's like if people are buying puts for tomorrow or the next day, or 2 weeks from now, that matters more than if someone's buying today's puts, because if you're buying the 0DT, it's going to expire or they're going to close it, and that can bring the rally. So I don't know what the trigger was. I'm not going to say that was the options market. But the options market absolutely exacerbated the volatility. Why do I say that? Because we went from, again, positive, this is dollar notional over here. We're around $400 million notional, $300 million notional, all the way down to, 14 billion negative. So that's 14 billion of flow just shoving the market lower. And a lot of that was non-zero DTE, right? That adds convexity. But what is this? It doesn't show up in flow patrol, as we just showed, as major put buying. So that means it has to be some sort of, market maker firm, could potentially be like a high frequency, professional customer type trader, whatever it is. But, whatever it is, it's seen more algorithmic. Also, the how linear this is, right? if you think about how a hedge fund is going to add a position, they're not going to one lot puts in all likelihood. This is like a TWAP order, right? And it's likely also paired off against some type of other order flow, like single stock, for example. So, and you can see that here, right? 1045. This is the S&P equity basket. So all single stocks in the S&P 500 add up to this basket. What is this? Same time, 1045. You can see this, right? The purple line is just cascading, and it doesn't stop. There's another $5 billion worth of order flow. What is that? Call selling and put buying in perfect symmetry. It was a little hard to see it probably, but look at this, right? Orange is call selling, blue is put buying. That is perfect symmetry. What is that? That's like selling straddles. So that is a volatility trade or a high frequency trade. That is not someone being like, hey, Lisa Cook just said the world's over. Like, we got to hedge our long equity position. You got to buy like 50,000, whatever, March puts. This is algo. You want to call it maybe CTA or something like that. Okay, but it's not like a real money put buying. And so the problem with that, again, is that flow is not worried about anything other than momentum, maybe rolling out of a position, relative value, correlation, those types of flows, right? And which to me is always different and less, it's more transient, right? It's here one minute, gone the next, as opposed to like, I bought March puts, these are my hedge, I'm not taking these off until March. So, again, when you're talking about how persistent can this drawdown be, or how sticky can this be, this is less concerning to me when it's like, okay, there's a high frequency firm that's shoving the market around, and this could all rally back by tomorrow, versus like, no, we're all hedging, the collapse of OpenAI and their middle out. So, yeah, and choppy right now. Let's just do a check of the HIRO flows in this negative gamma. So there's a lot of positions expiring, obviously on the close today. So that is this other dynamic. What is the issue here? If we don't move, if we don't start selling, then this vol's got to start coming in, right? So it's like, I use the analogy of, if you ever see those zero gravity, like you fly to the upper atmosphere and like you hang out there for a minute, and like for that moment you're floating in space, but eventually gravity picks back up, right? And it works the same with vol. It's like, only we crash and then vol is super elevated, right? And then what happens if nothing happens? Well, that vol is going to come in because we're not moving anymore, and we sort of have the anti-gravity. So that, that is the situation. And I was talking about yesterday about these puts, for example, and we showed how one D's put in the course of 5 minutes, just because the market stalled out. When the market was in mid crash and you're getting like kind of like the peak energy, the put, I think it was a 6,300 put, was $80. And then the market just traded sideways for about 10 minutes. That put only went to only worth $70. So you lost, more than 10% of your put value just because the market stopped moving down. And so, the energy of the market needs to be sustained. We'll just do a quick health check on some of these important stocks here. If you look at NVIDIA, this, we're rolling today, right? So it's going to be a little more non-zero DTE or non-next expiration flows, which is purple. This isn't a good look, though. Quite negative. Stock is now 177, so we're well below where we were. What does this look like? It looks like call selling. That's what's showing up here in terms of the Tesla flows, or NVIDIA flows, excuse me. You're looking at Tesla. What do you see? Call selling again in size. That's pretty big. 400 million already, 45 minutes in the day. We get as much as 2 million out of this session, but this is not a good look for the equity market when this is going south like that. Google, who is now maybe the best stock in the world, I don't know. That's fine. Meta, that's horrible. Not horrible, but ugly. Oracle stock is down 30% now in November. Not catching a bid. CoreWeave down 11 million. We're now at 68. So, where, if there's value, right, it's not being, people are not stepping into that value right now. This has all the marks of just kind of a lot more ugly downside. So, a little boost there, maybe Amazon maybe showing a little bit of relative light. So this is not a, yes, there's a lot of positional adjustment, particularly as we kind of open up the morning here, but the leaders in terms of NVIDIA, Tesla, the biggest options positions, those dips aren't yet being bought. Health check here. The Bitcoin volumes, I will be first to note that Bitcoin what's interesting about Bitcoin is when it was at 120,000 into that rally, options volumes, IBIT, ETH, BMNR, the Tom Lee thing, huge, right? Top 10, top 15 on a daily basis. And then all of a sudden that evaporated. And then 2 days ago, when IBIT and Bitcoin hit 90,000, the volumes picked back up and put skews got very expensive on a relative basis. I was flagging that as a potential time for a bottom based on those flows. I've obviously been run over on that note, but these options volumes picking up again tell you there's a little more focus on that sector. Who knows what sort of releases the pressure at this point, but the fact that those options flows are picking up a lot to me was a signal of a potential low. Obviously, it's traded through that. We were talking about this in the founder's note on the point of skews. Look, these are all the top options names, right? So you don't have to pick out an individual one. The point is, look at the path of how this has moved over the last 3 days, right? Everything was really rather bullish, especially if you go back 10 days. All these names are over here in this bottom right quadrant. What does that tell you? Vols are relatively low. Calls are bid relative to puts. That means you show up on the right of this chart. And then all of a sudden, in the last 10 days, we've just absolutely slammed lower. This went from peak confidence to now. This is over the last year, right? So if you're talking about over the last year, you look at IWMs, well, the risk reversal rank, so how bid are calls relative to puts for 1 month 25 delta call versus 25 delta put, it's as bad as it's been in the last year. That goes back to November of 2024. So the April, whatever that April staring into the abyss situation, we're almost as bad as that in terms of the risk reversal rank. So nobody wants calls in any of these assets right now, right? They just do not want them because you're now talking about April of 2025 level of put hate, call hate. Let's just break this down by skews a little bit because it'll give us another piece of information there. So look at these put skews. I mean, NVIDIA, 6% call skew percentile is as low as it gets. Huge put skew. This, everybody is just absolutely hates everything. Now, the IV ranks aren't all that elevated. Avgo has earnings coming up, so, if we were in April, we'd see the IV ranks way up here. So, unless we are at April, and there is a reason to think we're at April, then these vols are absolutely expensive, and you can see these puts get crushed, and that in and of itself is fuel for a 2 to 3% rally, at least back in the 6,700 area. So, that is the hard part. And again, because we don't know what the catalyst is, it's like, well, what is a man supposed to do? That's why I like the call fly, because I can put that cheap call fly on and okay, that side of the equation is taken out, and I can think more about this downside. Now, in the founder's note again, we would normally say if you think vol is rich, you want to sell vol, but this is the type of situation where you get taken on a stretcher because something happens on a weekend. And in a weekend like this, where stuff is whipping all over and, there's 8-9 catalysts, things tend to sneak up on a Sunday night when the market's not really fully open. And you're like, Japan's down, 10%, because of something that we all don't understand, right? And no support in this thing till it was 6,500. Now you see this positive gamma, maybe 6,475. Well, if you look at net open interest, that is now getting closed up, right? So, this is a very, very soft bottom, I will call it, to these positions. And we just go back and do a HIRO health check here. Why is HIRO valuable in these situations? You want to see put selling, right? And put selling would show up as the purple line going higher. The teal line is 0 DTE. You want to see that going higher. 0 DTE is going to be very skewed by expiration, right? So you want to be aware of that. But if this purple line starts to go up and you get the signal that puts are being sold, you can see this morning light blue is 0 DTE puts, dark blue is all expiration puts. So those are positive. Those are higher than calls. What does that mean? People this morning started selling puts. Now, put sales can be one of two things, obviously. You can own puts that you're monetizing, or you could be shorting them. Now, in a perfect world, you want to see put shorts coming in, right? Because that infers that there's going to be, persistent hedging flows to the upside in theory. But put closures also is a great signal. Orange is all expiration calls. Green is 0 DTE calls. So the only calls trading really today in material size seems like 0 DTE. So, if these put flows turn up, that's a great signal that the market's going to find some stability. This is the S&P equity, single stocks, again, all 0 DTE. No one's really sticking their neck out at this moment at all, other than to sell calls, it looks like, in NVIDIA and Tesla, which is likely some rolling. And on the point of NVIDIA and Tesla, you talk about the correlation or dispersion trade and how big 0 DTE volumes are. I am not going to articulate, or I can't articulate specifically how this is traded, but you have massive 0 DTE volumes in NDX, QQQ, spiders, etc. And then the only other single stock products that also have massive 0 DTE volumes is NVIDIA and Tesla, wherein people day trade those using the next expiration. And there's such a fundamental difference between these top names on a daily basis. You'll get 2-3 million NVIDIA, 2-3 million Tesla, 3-4 million SPX, et cetera, et cetera. And then you go under that tier, then any name that has 1 million contracts traded on a daily basis, this is obviously 10:30 in the morning, it's like a second total tier. So there's this complex of day trading in those, 5 or 6 products, spiders, Qs, Tesla, NVIDIA, versus kind of everything else, right? So the reason I bring that up is because when you're looking at the HIRO flows in NVIDIA or Tesla and saying, wow, this is quite negative. It is negative. It is negative deltas, but don't misconstrue that as the reason that these deltas are so negative is because, somebody thinks that NVIDIA earnings are terrible and it's the end of the world for NVIDIA. It, in all likelihood, has nothing to do with the fundamentals. In Flow Patrol, you'll see the fundamentals. But there's just these technical HFT type flows, right? Quantitative flows that are so prevalent in these products, NVIDIA and Tesla specifically. So again, this all speaks to something quite ugly at the moment. As HIRO rolls over, that's the purple line here, right? The support that was implied this morning based on these 0 DT positions, those have now been closed up. 2 levels, 6,500, then 64.75 was closed up. So this is really quite tricky. On this point, what are interesting hedges? We talked about the put fly this morning. So this is the put fly that traded in size, right? And so try to open this, make it a little bit bigger. Now you can load this put fly up on our calculator and play with it a little bit, but this is the 150,000 lot put fly that we talked about. This is 12/12 expiration, 300K of the 555 puts, and 150K of these 595 puts. So what's interesting to me about this structure is I don't know what price they put it on at, but you get, if the trade just goes up, your debit, as I calculated time, was basically $1. I don't know if that is still achievable or not. I use pre-market prices, so that's maybe off a little bit. But the nice thing about this is that if the market declines, obviously you're generating a fair amount of P&L. But there is this interesting area of kind of time and price, or time and skew, I guess you'd put it, where the goal oftentimes is, as I've stated, is what you're really trying to do is get a free put. And in a high volatility environment, you don't want to overpay for puts. It's very easy. So the way that you can do that and lean on the skew is buying one of these and then selling 2 of deeper out of the money options. Now, if you go too close in time with that, right, if you try to do this like tomorrow, it can be tricky because while the 555 put is going to have higher implied vol, that could be like a nickel option, right? So then you're just overpaying still for that kind of near-term put. So this is a nice balance where when you adjust vol, which is what we've done here, if you raise vol, the P&L of the structure actually gets a little bit worse. So if you drop and vol goes up 10 points, the P&L gets a little bit worse. And that's because these 2 puts gain in value relative to the one that you've bought, right? But irrespective of all that, this structure still seems to be generating positive P&L into a weaker market, and you're not paying too much. Again, if VIX goes to like 80, the P&L of this trade is not going to look great, at least initially. But if you're talking about another 10% down from here, this structure looks pretty good. And if we drop sharply, let's say to 6,000, right, or 600, or even below that, I mean, that's a really major decline. The decay of these puts over the weekend or whatever could actually make this P&L look a little bit better. So I think it's a really interesting hedge if you're talking about a major move. We're still way up here. So into next week, this could be a good trade if we actually do spill a little bit lower. Again, I think 63.50 is the level that I'm watching as a potential washout low based on what we're seeing in the GEX positioning here. So see here. Yeah, I bet a lot of just insane trading volume there. Absolutely. Flow Patrol release time. So we have had, admittedly, some problems or delays in sending Flow Patrol out. Flow Patrol, in full disclosure, is completely written by AI. So all this analysis here is AI generated. Get a little nod to that there. We marked that here. We had problems with the Cloudflare, the global internet outage. So that was a things like that have generated some problems recently, but we are working to get that out. Our data finishes running around 7:30 in the morning Eastern time for this report, and then we send it out after. So that is why you see that there. I don't know anything about the Venezuela issue. I generally think, if you talk about like the Russia-Ukraine situation, like initially when that war fired off, that was a problem. Then, then you have the Israel-Iran war that caused some volatility. But those conflicts, the Israel-Iran thing, I guess, resolved. Ukraine's still around, and the market still made all-time highs. So I think the geopolitical situation has to be like, are we potentially warring with another nuclear power, I guess, would be the concern. I think Venezuela is maybe not that, but I'm talking talking in an area that I don't fully understand. So I wouldn't think that would be a problem. This is a problem with Bitcoin going so low. I saw something that the MSTI may prevent Bitcoin treasury companies from being in the indices. They should never have been allowed in indices, or Bitcoin crypto related names shouldn't have been allowed in indices, in my view, other than like Coinbase, which has a real business. But MicroStrategy, do you remember when this was added to the S&P 500? Right here. Or added to the NASDAQ rather, right? So like, yes, it did double bounce here when crypto was threatening to take out all-time highs. But guess what? Like, if you just break down, and I've talked about this a lot, but MicroStrategy is a business. And the reason this sucks is because you see people who quit their jobs to talk about MicroStrategy or its products, and the whole thing is just a joke. Why is it a joke? If it's actually buying Bitcoin and Bitcoin goes to 2 million, then obviously it's going to be quite a company, right? But what are some of the chicanery they're doing? Well, mining Bitcoin vault, or mining the volatility of their product, right, to buy Bitcoin itself. So you'd sell convertible bonds and use that to buy Bitcoin. And that's a Ponzi scheme, essentially, right? Now, the problem with this is that the more convertible bonds that you sell, right, the traders there are buying those bonds to trade the volatility. So what does that end up meaning? Well, like in the very simple terms, what I saw is size call selling in MicroStrategy on a daily basis, right? These giant positions, which I would associate with the convertible bonds. So by selling the convertible bonds to mine your volatility, you basically squash your volatility, which means you couldn't sell the convertible bonds anymore. Then you start to getting into more financialization of preferred shares and debt and all this other stuff. I'm not going to pretend to know the exact details of this thing, but it's sort of like when you see an elephant, you're like, oh, that's an elephant. And so you could see it stop keeping pace with Bitcoin as Bitcoin was going up. So, and then other mining company or treasury company, whatever. So, shenanigans, right? And so I don't know at what point Saylor has to, liquidate, if that's actually real or not. I had seen somebody was trying to say 180,000, but that doesn't matter until, next year or the year after when debt becomes due. I don't fully understand it, but what I do kind of believe or start to believe is, when there's blood in the streets, right, or you smell blood in the water, like the sharks come out. And so, this is this a situation where they're going to have to liquidate Bitcoin or whatever? I don't know, but it does. Like, why would someone want to buy into that, right? I think that's a major problem. So, is this weighing on Bitcoin because you go, well, this is one of the biggest owners of Bitcoin that may start to have problems? That's possible. But then also, this company became big enough in terms of market cap to probably cause some equity problems too. So, that's just that's a nasty situation. This BMR thing owns, a ton of Ethereum, I believe. So, is this just sort of is this the microphone here? Is this the abyss for some of these companies? Because finally, like it's time to pay up, right? Yeah, the common shareholder provides credit protection for the bondholder. That's right. So that's the problem here when you're talking about micro or Oracle or something like that. I mean, CoreWeave has gotten absolutely nuked, right? We put on some put spreads here on the idea that if NVIDIA missed, right, then this would start to move down into, the level at where it was sort of opened. And what a major loss for this asset, as you can see here. Now, the hilarious thing about this is that all of these put spreads that we put on is the downside hedge into NVIDIA missing. Those trades all seemed just dead. They were like worth nothing, so you just leave them on. And then suddenly here we are, like 24 hours later, like, oh, thankfully I put on all of these trades. There was also an interesting OpenAI headline. I don't know if it's true, but it was saying that Sam Altman was worried about Google. I mean, this is the problem with Twitter these days. You don't know what's true or not true or this or that other thing. It's tricky. Can't pay your taxes with Bitcoin. That's true. Ucoin are saying, can we show that the options calculator for IWM can be used for directional trading? The problem for intraday trades with the calculator is that the markets are obviously right now very fast. And so I don't know that you're going to use an options calculator other than strict P&Ls, right? Like binary payouts, if-then statements, which is this is showing, right? What I mean by that is where the calculator excels is when you want to model volatility in specific ways, kind of like what we were doing with the 1x2, for example. And so, if we're looking at the put fly in, well, I had saved a couple trades actually the other day. Are they still in here? Yeah. So this is the CoreWeave NVIDIA play that we put on. This is the put 1x2. And we were talking about this on the Interactive Brokers webinar, the NASDAQ, and then I believe in one of our Q&As too. And right, so this was the 1x2 in CoreWeave, and what made this trade interesting, and still may make it interesting, and why I like the 1x2 is because number one, from just a technical type positioning, you can see this is where we kind of IPO'd right around the 50 level. There's a fair number of positions there. But then when you start to get under 50, you start to talk about the stock finding its ultimate lower bound, which is 0. And so a lot of times I think that options prices can be sort of skewed or, the vols, price in the fact that is the company likely to go to 0, at least in the next 2 weeks? Probably not. But you could have, obviously a pretty sharp move. So in the spirit of saying, and you could use this for IWM or whatever else, in the spirit of saying, I'm trying to get a put, right? For as cheap as I can. In this case, what we outlined here was this is the Oracle trade. Sorry, I was getting confused by the strikes. So in this case, what we did is the 1x2 for 12.5 with the idea is that we're trying to buy this put and offset the cost of it with this 50 strike put. And this 50 strike put is the area where we think that we would find some implied support here, right? So if you talk about just if the stock started to bounce, right, or as we feed into that level, you can see that this starts to generate pretty solid P&L into that 60 strike or the 60 zone, right? But it matters how vol moves. So what do I mean by that? If we open up this vol settings, and you can see where are we right now in terms of the vol, it's right here. And so if the stock was going to go down, what I've modeled in here is saying we'll probably see vol increase about 10 points, right? And you would probably see put skew start to increase a bit. So I'm elevating that skew. You can see that red line goes up. And now what you're getting is arguably a more true sense of what your P&L would be. So my P&L actually gets a little bit worse in a put fly like this, or 1x2 rather, when vol increases. Again, same thing as the spread we were talking about before, because the two that I'm short increase in value. But then there's the time decay factor of that. So if as I move through time, you can see the structure, assuming the price ends up around here, right? The P&L of the structure gets better. I'm more rewarded. Now, the tricky spot here is obviously in a market like this, we crash. We don't tend to just stick, right? We tend to bounce, like crash and bounce. So that makes this a little bit tricky. Now, if you're playing the call side and you have the glide path of stock rallies and then like levels off into upside, well, like, okay, that pinning is a lot more of an option, I think, or a lot more of a path to consider versus like a violent downside situation. So what I usually like to do with these is I'll leave the orders out. I'm never trading, I don't trade massive size or anything like that. So, if you have, say, 10 of these things on, I'll put a few of them on trying to recoup my initial cost, right? So if I'm paying 60 cents or something like that for this structure at 30 cents, I'll try to recoup my initial cost for the whole trade, the 10 lot of trades, for example. And I'll leave the orders out there because a lot of times the market will jump, vols will do weird things, and then suddenly it'll be calculated that spread is good value for a market maker or in an auction or whatever, and it will trade. And then I'll leave a few more on in case we get to the ultimate sort of P&L path, so to speak. So that's the way I like to trade those. But in this market, you have to adjust the skews, right? The skews is everything. Not everything. I mean, the implied vol shift up and down matters. But, in this situation where that put wing is quite expensive, right? What's going to happen if the market crashes? That put wing is going to get even more expensive, right? Because you're talking about credit default swaps in CoreWeave are going crazy. Like the put skew is going to go full. I can't see the word I was going to say. I don't think anymore. You can model out, right, the situation, kind of the worst case scenarios, and see how that P&L really adjusts. So, vol increases here. You can see why you'd want to maybe offset that position a little bit earlier. So again, leaving some prices out or leaving some orders out to offset the cost of the structure. If the stock gets down into 60, you're like, great, I've covered the trade or the cost of my P&L. Now, again, the scary thing here is if the stock really starts to tank into 12.5, and I'm willing to accept that risk here because I know what the lower bound is. It's 0. And is the company likely to go completely out of business, by 12.5? Probably not. There's no definites here, but that's the rough idea or area. We're kind of plunging below here a bit, aren't we? Everyone's hoping on the Santa. This is that soft underbelly, right? And if you're going to say what is the level, there is no level. 6450 under here, 6400. This is where the puts get long. And you see some are closed up this morning already. Those are 0 DTE puts. If you go non-zero DTE puts, here's the 6330. This is the JP Morgan position, the collar position. So that into the end of the year should be a support area. Typically, we don't see the market breach that level. I mean, again, you need a real catalyst here. You need like the market. You need something officially breaking. Like here is a problem. This is a margin call. MicroStrategy is out of business. JGB, whatever. Something, right? Rumors into window is not enough to maintain vol to 27, 28, particularly over the holiday weekend. So, but yeah, you could see here, right? Like under there's no real position. So this is why we kind of highlight that area. Kind of peak negative gamma area is this really bright red area of the chart. And so that's where we're watching as that full kind of washout level. And that's the level that's been in the cards here for a couple of days. And not to say, you don't sit here and say, I knew that was going to happen. I don't. But if you're going to break me under 6,700 and the sentiment is still negative, I don't know what the catalyst is, but people are clearly selling. You're like, okay, when is the area where the options market may stop exacerbating downside? Well, at 6330 or 6350, that's where I start to go, okay, the options market itself may start to sort of offer some support. But right now, there's no implied support, at all here. Which again, one headline this thing turns around, which makes it so tricky, and no one ultimately knows, what the path will be here. But you just have to keep your mind open to much further downside until we start to have the options market saying, okay, this is where the positioning can help. Hey, VIX at 50 means like we're probably washed out. Like there's enough volatility alpha here that I'll stick my neck out and sell a put because they're so expensive. I'll take the risk. Right now, like I don't want to take the risk again into the weekend because the weekend could be, when you get carried out in a stretcher. It's happened more times than I can count where it's, obviously the Monday morning where things just get like to be the worst. This weekend could, of course, be fine, but why take that risk? Unless, hey, VIX closed at 80 today. All right, I'll take the weekend risk maybe. But VIX 27 is not all that sexy. Yeah, no real lack of call buying there, prop desk junkie. I would agree. You just don't see it. No one wants to buy the calls really in anything. And so here comes the other question. And like, at what price do you say, well, there's value here, right? Like this stock is just so cheap that on whatever your fundamental basis is, metric is, this is getting interesting. AI is certainly, or Nvidia, excuse me, is certainly more interesting now than it was, 2 weeks ago. But how much of this OpenAI middle out situation is like real or not? I'm not going to pretend to have any idea. Um, like you look at Mike Burry, for example, and you think that, hey, well, fair value for Nvidia is probably $100 or whatever. I don't know. How well I know? Well, I'm going to see put sellers come in. Call buying here is not going to be the first order effect. Like buying a call in this situation is just doesn't make sense. And you can look at the P&L of that all day long. But if you buy just like an Nvidia call because you're like, great, this is this is over. You got Oracle earnings coming up in a couple of weeks, so that could be another situation. But so let's just think about this here. Look at, even though the Nvidia call skew is very low, this is where the Nvidia implied vol rank is 43. 43 into non-earnings event is elevated, right? That's quite high. Not screaming high, but the problem is that if you want to play that bounce, you're going to pay a tax based on that implied vol. So if you're saying, great, I want to play 1 month Nvidia calls, just a pure long call, nothing special, 12.19. Let's go with the 25 delta call, so you can see the delta down here. Standard operation stuff. Go 195, sort of the fancy round strike, and this is your payout. And you think like, hey, that looks to be a great way to play this bounce. Well, what happens when the vol comes in? So here's current implied vol, and vol would obviously normalize. So there you go into the middle of that range, maybe. So there you go. With the skew steepen a little bit, if people pile back into calls, all right, I'll give you that. So we'll raise the skew up a little bit. So there you go. Not a huge difference there in the model, but now you see what the difference is in P&L, right? You see that drag. So this is, if you go into early December, right? You want to say, I'm going to get out of the way for Oracle reports and for the FOMC. You think you're going to make the yellow line, $170 as the stock rallies, right? Well, what you're actually going to make is the purple line. So, it's $150, $200 difference. So a lot of you would be like, well, I'm still making money, but it actually takes a lot longer to make money. Like the standard model will tell you at 180, you start making money. But our model says, no, you don't actually make anything until about 185. So I think a lot of times that's a difference, though, between being a consistently successful trader and one that misses, because on the edges, you're just arguably giving away some alpha, or call it a transaction tax even, by overpaying. So if you did the call spread, then arguably you could do a lot better. Now, if this bounces because, I don't know, China buys every chip, they're suddenly a huge deal. Obviously, the vol would persist if the market bounces. But in all likelihood, if this rallies, that vol is going to come in, which is again why we like that 1x2 we were talking about before, right? But you want to be aware of that dynamic here. So getting to the other point, if you think that puts are expensive, well, what likely happens if the stock rallies, right, and you sell the put? That ball comes in. So initially, at least in the short term, what is going to be much more exciting here is if you sell the put, right? Because why? Because if you look at the vol and the vol comes down, and that the put skew is going to flatten, remember, right? Because the put skew is 95 percentile. So that put skew flattens out. And we'll load in the 25 delta put just to make sure it's apples to apples kind of comparison. This is arguably a more of a interesting way to play long here if the market rallies, because that vol is likely to get crushed, right? Now the problem is you have a lot more downside exposure. And in this market where we don't know what the catalyst is, and things are a little bit confusing, being short a put is not always the best. But you can see how that implied vol works in your favor, obviously, if the stock starts to rally. The short put, the other advantage is that obviously if the stock just stops going down, then that vol and time decay works into your favor. So, the thing that you're going to want to see that people are really willing to stick their necks out here is selling puts, because if you're selling puts, then you're willing to accept that downside risk in a way that you're not if you're buying calls, right? Both are going to pay, or both have to deal with the change in implied vol, obviously. But you have to be cognizant of that decay. So I don't know what's going on, and I don't have to. I just have to see other people, particularly size, like willing to step up here, right? If I see clearly institutional buyers here, well, the institutions are smarter than I am in aggregate, so let's just see what they're doing. And when they start selling puts and they start buying calls, then I'm going to feel a lot better about the situation, right? When fixed strike vols start coming in and you start to see that put skew come in, okay, like then that's an all clear sign for me. Um, it's like what the famous kind of saying. It's like you can talk all you want, but until you actually put a trade on, you're not committed, and that's what you want to see. I just want to see some commitment here. So let me load this up. 1222. I just want to compare the skews from. So this is the S&P skew, right, for 1222 expiration. It's about 1 month from NVIDIA night. So remember, vols were elevated into NVIDIA night to today. And just on another signal of risk, right? What do you see here is a pretty the shift from this morning, which is teal versus 2 days ago, right? We're higher, but it's pretty neutral. It's pretty even. Like the spread is pretty even across the skew here, right? If it was a really risky situation and indeed people were buying tons of out of the money puts, then you would see the skew increase on a relative basis. So you would see the teal dot, teal line, you would see a spread like an alligator mouth. It'd be a little bit wider up here, right? So, this seems to just be pricing in the extra vol. The flows we're getting are, they were negative. They seem to be a little bit more neutral now. Again, it's hard because of expiration. There's a lot of stuff moving around, but kind of like yesterday or the start of this conversation where it's like, where are the big, huge, scary put buyers? Like they're just not there. That doesn't help us in the lack of absence of buying. But if you're going to talk about VIX 30 or something like that, you need call buyers, VIX call buyers, or S&P put buyers. And what seems to be now is more of an absence of that as opposed to so it's sort of an absence of flows, no call buying, no real put selling versus the kind of flows that drive that downside. So that is the story. All right, we've been going for about an hour here, so probably wrap this up at the moment. If you're watching, the signal here, you want to see all expiration, put flow, and HIRO going up. It is doing that right now. You see this put selling seems to be increasing a little bit off this 55.30 level. So you can see that starting to increase. If that continues, right, if that trend continues, then that is a great sign for traders. Same thing on the single stock side. Now you're seeing a little bit of put flow coming in. So maybe that trading off of the 6,500 level was a little bit of a signal. Again, this is tricky and it's tough, which is why I like that call 1x2 structured in early December, because I don't have to worry about missing the substantial rally now, right? Like I have that upside. And so it's like that wing is now, that's in play for me now, right? I don't hold any core short position at the moment, but I am worried that this all clears and all is equal. I think that is an outcome that is obviously very viable, but I lean that way because there's smoke right now, but there's not an obvious fire. It doesn't mean I want to be short vol this weekend, which is the 1x2 call spread. It means that I have fixed risk. I'm good with that. And if indeed everything's fine on Monday, then we're probably going to see that rally again because you start to worry about, okay, OPEX is a lot of negative weight cleared off the market. The vol should decay, particularly into Thanksgiving. So it's like that is the only trade that I see is like obviously viable at this moment, that 1x2. But don't misconstrue that as like market's definitely rallying off of here because it's very choppy and tricky. So that is a nice trade, nice risk reward there. Plays the vol contraction. If you're wrong, fixed risk, no big deal here. So those are kind of the dynamics to watch as we head into the weekend. All right. That's going to be it for me. If you want to check out the Flow Patrol report, please do. And you sign up here, you will get the Flow Patrol. I think you get it for 7 days for free. Yeah. We email it to you. It's a PDF. You can share that with your friends if you'd like. Or if you don't have any friends, share it on your Discords or whatever. This is updated every single day. And obviously for subscribers, you're getting this every single day. And eventually we'll have this in the old dashboard. If you want to watch any of these amazing tools, Trace, HIRO, etc., so informative yesterday as to not buying the dip. And the reason we could say it is because the dip just never showed up in here. There was just never at any point sizable positive deltas coming into the market. And what do I mean by that? Like you could just see this all day, right? Like there's no bounce. We we just make this as simple as possible, right? Total flows. The purple line is HIRO. There is no bounce at all the entire day, right? And so what am I talking about? A bounce. You want to see the purple line go like this. That's what I'm going to be looking for today. The purple line shooting higher, $1, $2, $3, $4 billion of the positive deltas as a signal that there's at least a short-term bottom is in. That is what we want to watch for. You can't predict if that's going to happen. You just want to see it happen and then go, okay, this is a sign that, that maybe a short-term bottom is in. So we're going to be watching this. You want to see at least $1 billion in this market, probably $2 billion to be material and real. Right now, we're only doing, as you can see here, 700 to 300 million. So it's about $400 million. It's not all that sizable, right? So watch for $1 billion of at least of signal. If you want to try this out, that's part of the Alpha membership at SpotGamma.com. Go check out the Alpha membership. That includes HIRO. That includes Trace. If you just want to try out the calculator, that's part of the standard membership. We are going to be doing some Black Friday stuff next week as well. So if you sign up for Flow Patrol today, you'll get the Black Friday deals when they come out. I've seen the Black Friday deals. I think they're inappropriately low. This is a joke. Anyways, we'd love to have you at the SpotGamma community, and thank you all to our SpotGamma subscribers. Enjoy your weekend. I hope trading goes well. If you have any feedback, info at SpotGamma.com. We'd love to hear it. If you have any complaints, you can email them to somebody else. Just kidding. We'd like to hear your constructive criticism as well as things that are working for you. So if you sign up today for free, does it start Monday? Flow Patrol just gives you I believe you get the Flow Patrol today automatically. And then on Monday, you'll get the report. So you should get today's report for the 7 days. But if you sign up today, you're going to start getting some Black Friday deals, which are pretty good, thrown your way next week. So it's a great time to sort of get your feet wet with that Flow Patrol stuff. And then you'll start seeing those deals, I think, start leaking out there on Monday. So, all right, that's it for me. Thank you, everybody. Enjoy your weekend. Michael, thank you so much for the kind words. Appreciate you showing up so much around here. Tread lightly this weekend. Again, that's sort of the headline. Don't try to be a champion here. I'd like to call 1x2 for early December that we outlined in the founder's note if you want to talk about some of those interesting trade ideas. And again, info@SpotGamma.com.